Joining us now is Erik Hirsch, Hamilton Lane co-CEO. Hamilton Lane is one of the largest private markets investment firms across the globe, and it's not just Bank of America, it's Morgan Stanley that's also apparently buying some insurance on some of its loans. Erik, are you one of the people who's extending these lines of credit?
We're not, and Matt, great to be with you. So I think it's interesting. There's a lot of talk about sort of a private credit bubble that's sort of hanging out there. And yet when we actually start to see the problems and see actually who's been doing some questionable lending, it's not the big private credit firms. It's much more of the banks. So I don't find it all that surprising right now that what we're starting to see is the banks reassessing their lending practices and reassessing what kinds of positions they want to be maintaining on their own portfolio.
Well, and we've seen lately some pretty high-profile problems, right? With Saks, with First Brands. There's a lot of debt that you may not have expected, 50%, 60%, 70% drops from, but it's been happening. Are we seeing cracks in credit?
I don't think we're seeing cracks in credit. I think what we're seeing is some questionable lending practices by some folks that don't, frankly, have the same resources and skill sets to play in the game. So First Brands is a great example. You look at who the big players were, the big lenders in that. They were not the big private credit firms. You did not see the Ares, Apollos, KKRs, Blackstones. They were not playing in that company. It was, in fact, much more bank-oriented and hedge fund-oriented. So for us, this is simply a question of be careful who your partners are. There are a tremendous number of people providing capital into the market. There's no shortage of capital. And I think investors just need to focus on who they want to back, who they want to partner with, because I don't see a sort of substantial problem with the sector or the industry. What I see is variation, not surprisingly, across the actual individual players.
So what do you think is happening in these individual situations, and how wide will the ripples spread of something like a First Brands?
So I don't see a big ripple. I think what we see today is equity to borrowing ratios look relatively conservative. Overall leverage levels are looking fine. We're not seeing a high level of default in the market. And so I think these are much more episodic, which is, again, not surprising, happens all the time that you've got a bad borrower or a bad lender or a bad combination. But that, to me, does not translate into some systematic or systemic risk across the entire sector.
All right, so we have big bank earnings coming up over the next few days. You don't think we're going to hear anything about, Tricolor or Saks from these banks? It's not going to be big enough to affect their earnings.
I don't see that, no. And I think if you sort of counterbalance that with what's been actually pretty positive, you've had a pretty robust IPO market for the last few months. The banks are doing well in the wealth sectors as that industry continues to grow and thrive. Overall equity market performance has been good. So no, I wouldn't think that what we're seeing here is going to warrant any sort of hit to earnings.
And M&A has been, $1 trillion of deals in the quarter. It does feel like there's a lot of, Friday notwithstanding, energy back in these markets, animal spirits back in these markets. IPOs are happening again, as you mentioned. What's your outlook?
Well, I think we're going to continue to see more of this. So again, absent some huge trade war with China, which is certainly a possibility, but I think what you see is the public market is looking for more product. There's real pent-up demand there. The private markets have a lot of high-quality companies that are looking for liquidity and looking for an exit, and so I think that pipeline could stay strong for a while.
What do you think the future of investing for retail looks like? Because as you mentioned, there's not a lot left to access in public markets. In private, everyone's reaching for that special sauce. So are we going to be able to, retail investors, for example, invest more directly in private markets?
Absolutely, Matt. And so you're already seeing it. The number of products that are now available to the retail customer has never been bigger and continues to grow. And I think right now it's not so much even the retail investor looking for a return. I think what they're looking for, and frankly smartly, they're looking for diversification. So if you take the average enterprise value for the public companies around the world, it's literally $100 billion. You look at the average enterprise value for what sort of the private markets are focusing on, $2 billion. So part of this is simply accessing part of the economy that's a big driver of the economy, which is small and medium-sized businesses. Those are not publicly traded. Those exist only in the private markets. And so if you're looking for a well-balanced, diversified portfolio that's getting access to all of the economic drivers, you're going to need to have exposure to the private markets. And that is just the reality.
So will retail investors need more transparency, a better look into these private companies, or will they simply need to have a strong fiduciary representative?
I think it's going to be both. I think what you're seeing is transparency is on the rise, as it should be. And so the SEC and other regulatory entities are very focused on making sure that the retail investor is protected. And at the same time, we need to see education levels of what private markets are and what they are not. As you know, there's a lot of myths around the private markets. And so getting people's educations higher, having access, having transparency, all of that is here. All of that is continuing to evolve and grow. I think it's all a good thing. I think it's natural. I think it's an expected part of a maturing asset class. And if you're bringing in this new big segment of an investor, I think it's to be expected.
All right, Erik, great to get some time with you across a broad swath of topics. Erik Hirsch there of Hamilton Lane.